Many people in trading talk about the risk-to-reward ratio as though it's the holy grail, as though no trade should be taken unless you have a proper 2 reward to 1 risk ratio in each trade. But guess what? They're only looking at half the picture. If all you pay attention to is your risk to reward, you really don't know anything about how your trading is going. In this video, we want to spend a few moments with you showing you a way that you can combine understanding of risk to reward and win to loss ratio. By combining them together, you can finally get an actual analysis of how your trading is going and how strong your trade plan really will be. To do this, we've created a special spreadsheet. This spreadsheet is available to Forex Smart Tools owners of the Forex Smart Tool Calculator and Trade Log. And it's also available to people who've signed up to our newsletter series. If you're not yet enjoying our newsletters, please go to forexsmarttools.com and choose Tips from the menu at the bottom, or choose forexsmarttools.com/email_signup. And by signing up, you'll be able to receive this spreadsheet that we're about to show you without any charge or further obligation. So let's take a look now at the spreadsheet. When you look at the spreadsheet, you'll find 5 yellow boxes, and these are the boxes that you can modify. The first box you'll see is what is your average stop loss that you use in number of pips. The second is what is your average take profit. The third is your theoretical target for the number of wins per 100 trades you take. In other words, what is the win to loss ratio? And you can put in a starting equity and, of course, your risk profile number. Here we've just used an average 2% risk per trade. And of course, this is something we really emphasize knowing quite accurately in the work that we offer you with the calculator and the money management education series. So let's take a look at how the spreadsheet works. What we're actually doing here is generating 100 trades in a random order of wins and losses. And each time the spreadsheet recalculates, it creates a new random distribution of those trades. I'll scroll down now, and you can see all 100 trades here. So you notice in the second column we have random wins and losses. Sometimes we get consecutive wins, sometimes we have consecutive losses. So because this is random, we're getting an unequal number each time we redistribute. So how do we recalculate? Well, simply go to any one of these gray cells and put in any number you like. It doesn't matter at all. It's not used as part of the recalculation. It's just used to kind of wake the spreadsheet up and regenerate the random distributions. So you'll notice I'll do a few of these, and you can just watch how each time we're getting a different number of wins and losses generated here. So we're going around and about this target of 64 here. Sometimes we'll have more, sometimes we'll have less. And guess what? That's pretty much like real life too, isn't it? If I put in 70 here, that I have a 70% win to loss ratio, and I wake up the spreadsheet to recalculate, you'll see that it kind of hovers around that 70 number. Sometimes a few more and sometimes a few less. What you're seeing in these top 2 squares, the pips, stop loss, and take profit, that is the risk to reward ratio. So if we put in, I want to have 11 pips every time I risk 11 pips, that's obviously a 1-to-1 ratio, which we represent here as 100%. If you go for, I want to have twice as many pips when I win as I risk, well, in this case, that would be 22. So if you see 200% here, you know you're looking at a 2-to-1 ratio of risk to reward. Now, obviously, if you're doing that and you're winning 70% of the time, you're going to be making a lot of money. But you don't need to be winning 70% of the time to be making money at a 2-to-1 ratio. In fact, let's look at dropping down to just 40%. Where are we seeing the results of our trades? Well, we're seeing it in two places. We're seeing it here as equity change if we're using adaptive positioning, and here as if we use equity change for fixed positioning. What's the difference between the adaptive positioning and the fixed positioning? With adaptive positioning, after every trade, we recalculate our lot size. Sometimes the results of doing this will give us less beneficial results than using a fixed position, but many times it gives us much greater profit. We've done a lot of video tutorials about this subject, so we won't go into it in depth. But if you keep track of this each time you do this calculation and just kind of take note, or you can even have a piece of paper to the side and write down the results of each set of 100 random trades, you'll start to notice a trend that the effects of adaptive positioning are really pretty tremendous. For instance, in this random distribution, we see that having used adaptive positioning gives us an equity change of 100% over these 100 trades, whereas using a fixed lot size only gave us 76%. Still tremendous, but take a look at the difference. We made almost 28% more from our money by just changing our lot size with each trade. And you can see here, if we look at some of the trades, that's just what we're doing here. In the first trade, we started out with 1.8 lots, 1.82. Then because we made money in the first trade, we have a larger position size in our second trade if we're using adaptive positioning. And remember, the Forex Smart Tools calculator is designed just for this purpose, to enable you to do adaptive positioning with great accuracy, so you are never risking more than whatever risk profile you've set up. In this case, 2% per trade. So if you lose, you're only going to be losing that 2%. But if you win, you're going to be maximizing your percent. But now back to our main topic. What about the ratios between our risk to reward, which we're showing in these first two boxes here, relative to the number of wins to losses we have? So obviously, if you're making twice as much as you're risking and you're winning, say, 40% of the time, you're making money. What about if you're only winning 30% of the time? Okay, that's not good enough, is it? Look at how on both these cases we've dropped. But remember here, we're actually seeing about 25 winning trades. Even though our goal was to be at a 30% win ratio, in this particular set, we didn't quite achieve that. So let's recalculate by just putting in any old number here. There we are. We're exactly at the 30. Remember, each time is just like rolling dice to see what's this set of 100 trades likely to give me. So what we're seeing is that even though you've been told to make that 2-to-1 ratio, and you made it in these set of 100 trades, still, because you're only winning 30% of the time, you're still losing money. We have to increase this to, let's say, okay, at around 37%, we see that we can make money. How about at 33? Well, okay, even though we targeted 33, we're actually seeing 40% there. So let's roll the dice again and make the spreadsheet recalculate. So here at 35% trades, we're slightly better than break even, 6% to 10%. Okay, now, what if we don't necessarily believe what we've been taught? Wonder if we say, you know what? Wonder if 2-to-1 reward to risk is not a golden standard that I need to achieve. Wonder if I even go for like let's put in like I have a stop loss of 20, let's say, and I go for 15 pips or 12 pips. The idea here that we're trying to do is encourage you to experiment and see what you see for yourself. Well, obviously, you better be winning more often than 33% if you're using less reward to your risk. Let's bump that up to 60%. Not enough, okay? 65%? Ah, now doesn't this get interesting? At just 67%, we're seeing that we're in a profitable position. Even though we have not made even a one-to-one, we're less than one-to-one risk to reward. But so what? We're winning 67% of the time, and we're seeing with our own eyes that we are able to make money with this. A lot of traders can actually achieve more like a 70 to 75, even 80% win ratio. At 68%, our win turns up to be 17, 18%. At 75, 77% win ratio, even though we're less than a one-to-one risk to reward, we're actually only 60% risk to reward, we're still making fantastic returns here. And if you're at 80% reliable, remember here we aim for 80%. In this particular distribution, we actually saw 71. So let's roll the dice again. There we go, 87. 83% gives us almost doubling our money, 90% return over these 100 trades. So we very much encourage you to experiment with this spreadsheet and try your own trade plan. And then, of course, as we detail in our newsletter series where we really go into depth about how to use this, the best is to use the trade log and see what your actual win to loss ratio is and what your actual risk to reward is as you analyze the trades that you actually took rather than just theoretical trades. Using these tools in combination will be very valuable for you.